the middle class is basically getting rug pulled here through, this MMT, modern monetary theory, where we just use debt to expand the economy. Well, guess who's the loser is in that? The middle class is a loser in globalism, and it was a loser in financialization of the economy. And so we're basically building to a head here where the US economy is going to falter. And when it falters, it's going to be worse than 1929, as bad as that was. Because in 1929, we had the ability to get out of it, to climb out of it, to basically everything kind of stayed intact, if you will. This time, we're not getting through this one. I call it the Humpty Dumpty crash. There's going to be no putting this one back together again. Now, the reason why I'm in gold and silver is because gold is the winner here. When everything goes down, you have $250 trillion in assets that are at risk between stocks and bonds. 100 trillion in stocks, 150 trillion in bonds. They're both at risk. Well, if those assets are at risk, where do people move their money to? And gold is the obvious answer. Gold is the winner here. So the gold miners, the silver miners, and silver, they're just along for the ride. That's not the story. The story is gold. The story is the bond market. I want to finish with this, is that we've gotten to a point now where people can't see this, but it's becoming the elephant in the room. So the Fed was supposed to have a dual mandate of price stability and full employment. Well, that's gone. That's out the window. That no longer exists. Even though they say it is, they're lying through their teeth. Because the elephant in the room now, whenever they have a Fed meeting, is how do we ensure that nothing burns to the ground? How do we ensure? So they're basically, the only thing they care about now is stability. It's not about full employment or inflation. They could have solved the inflation problem at 2%. Very easy to solve it. You just don't print any money. Inflation is a monetary event, but they've been printing. They don't care. The reason why is because they realize that what's more important is the stability, right? Literally the stability of the economy. So it's not full employment. That's an assuming assumption that you have stability. So now when right now, when Warsh has his meeting, they're not, what I'm about to say, they're going to ignore in the room. They're going to ignore the elephant. The elephant's over there, but they're not going to talk about it. If Warsh was honest with them, but he can't be honest, because if he's honest, then it'll leak. And if it leaks, he'll sound like a complete idiot. So he can't tell the truth. We're in an era where you can't be transparent, because if you're honest and transparent, you get attacked, because people attack what they don't understand. So if Warsh was honest, if he sat down in the room and he go, okay, people, we have a big problem here. We have to ensure that the stock market doesn't crash, and we have to ensure that the bond market remains stable. And that's his job, literally. That's the elephant, those two issues. We got to ensure that the stock market doesn't crash and the bond market doesn't become fragile. But he can't say it out loud. And so that elephant is just going to keep getting, every meeting that they have is just going to keep getting bigger and bigger and bigger. And at a certain point, somebody in the room is going to go, okay, the stock market's down 5%. What are we going to do here? So it's about clown world, because we can't tell the truth. We can't be honest. Somebody yesterday on Twitter, they posted a list of 20 items where nobody's went to jail. There's 20 things, and nobody went to jail on all 20 items. And we know that all 20 of them, people are breaking the law. We live in clown world now. And so the Fed has become clown world as well. And again, the only thing that really matters right now is stability in the stock market, stability in the bond market. Everything else is noise. And gold is going to be the eventual winner. We can see where this is going. The Humpty Dumpty crash is coming.
So I want to explore that as a premise. So I think the central kind of idea, if I can parrot it back from the book, is we have this significant threat to the system from debt expansion and monetary easing and declining confidence in fiat currencies, and that what this creates is the architecture for the next big precious metals market, the next precious metals bull market. And the way that you get ready for that is a diversified kind of layered approach to creating exposure that starts with safer assets, and those are your bigger allocations. And in the framework, that's physical gold and silver. And then as you kind of move up the risk curve, there's a certain pyramid type of structure where, let's say, the riskiest might be miners that don't have output yet, discovery companies. And in the middle is sort of big miners, then junior miners, then it goes from there. And sort of the closer you are to companies that are big, stable, and have actual output, the lower the risk. And the further you go out to kind of the deeper you get toward the prospecting side of things, the smaller the allocation and the riskier that space. You've also talked about the sweet spot being somewhere in the middle. So a kind of a mid-tier operator that offers kind of the best balance of risk reward. The first sort of idea I wanted to ask you about is, in this world that you're describing, where you have this kind of hard reset, I think you've described it as a kind of monetary reset. How do you, and you've also stressed exit strategy, sort of knowing where you're going to get out of these things, because as you've described, metals have bull markets and bear markets, and the bear markets are long. So how do you approach, in this kind of a reset world, monetizing these ideas? Which is to say, if we get a hard reset, and you've talked about even something like the United States devolving into smaller polities and things like this, do we still have regulated, functional stock markets and the ability to take money and take profits on these ideas if they're in public securities rather than physical metals? Do we need to wait for that, or is the idea to anticipate before that happens and to trade the speculation of that scenario?
Okay, I'll unpack that. There's about 5 questions in there, but I wrote down some notes. So starting with the strategy. So for me, it's a lot like Michael Burry in 2005. He basically saw that the housing market was going to burn to the ground, and he basically said, okay, what strategy am I going to use to maximize my profit? And he basically went after the worst of the worst. And then if you watch The Big Short, he basically went after the best risk reward, and he called it a certainty. And it turned out he was right. And then, and for me, kind of that real high risk reward, that kind of the meat that he went after, is what I call a sweet spot. And so you want to ignore kind of the low alpha, which is the top 20 majors, your ETFs, and your royalty plays. Now you're going to get 3-baggers from those. I use them for diversification. Those are kind of like the base of my pyramid. But that's not where I'm going to make my money. The only reason why I own those is because I don't know when the reset occurs. I don't know if it's going to be in 6 months or everything in 5 years. So I got to have a foundation. So I use those stocks as my foundation, my base, which those have less volatility, but they still have 3-bagger upside. At least 3-bagger upside, in my opinion. And then the meat right in the middle, if you will, is undervalued producers and high quality developers. And that's kind of where you want to be. That's where you want to be 60, 70, 80% of your portfolio, for me, is those really high risk reward stocks. And then the very top is your exploration. or options. And I think you can just ignore those. You don't need them. In a bull market, I believe they just go after the real juicy high risk reward, your undervalued producers and your high quality developers. And my portfolio right now is pointing to a 7-bagger. When I started doing this, I said my goal is a 5-bagger. And I'm always conservative, and I'm like Burry. So Burry, I'm sure when he looked at his numbers and he looked at it, he basically, and it turned out, you can project out kind of what you're going to get. One of the question was, when do you leave? Well, for me, I'm not going to climb to the top of the mountain. There's no reason to. So right around a 7-bagger, I'll be out. But if it's really juicy, if it's still really frothy, but you have a lot of momentum, maybe I'll stick around for 8, 9, maybe. But I probably won't. I'll probably exit early. But now, Burry, as soon as he basically, once his plane landed, he got out. He didn't wait. And so some people, and I've thought about this, about leaving early, because he left early. As soon as he started making money, he was out. Whereas Mark Baum, he waited another year before he got out. And so some people are going to wait longer than others. I'll be in the middle of those two guys. I won't get out early. I won't get out late. But you don't want to. You do want to be careful. You want to wait. I've told people, when do you begin to exit? This is a key question you didn't ask. When do you begin? You don't begin to exit until it gets frothy. Now, what is froth? Froth is basically your PE ratio. So if you look at the current stock market, we have froth. We have froth up the yin-yang. The price Schiller PE is at 42. The all-time high is 44. And so you have froth there. So that's how you can tell. It is the PE ratios. I don't use PE ratios. I use free cash flow multiples. And the free cash flow multiples right now are in single digits for your producers, for both gold and silver, single digits, which is really cheap. And the reason why they're really cheap is because nobody believes in my thesis. Everybody thinks that everything's fine, gold and silver. No, they already had their run, silver went to 120. It's done, right? So nobody cares about these. So free cash flow multiple under 10, and they're going to double. And so so one of the things I look at is your highest quality producers. Those highest quality producers should all get into the 20s. And so once a few of them get into the 20s, that'll be early exit. Once they all get into the 20s, then get ready to get out. And then we don't know how long the mania will last, but that's when, I'm not going to be there for the very end of it, how long this thing lasts to the very top. But I could leave. I expect to leave a lot on the table. But like you said, you don't know what the financial system is going to do here when things start to break. So I'll definitely be exiting, once it gets frothy.